Well, welcome back to You Heard It From a CFP. My name is Matthew Coyle. I'm the head CFP here at Advanced Capital Group, or ACG for short, here in Minneapolis. Today we are going to talk about interest rates because the market is moving, and it's mainly because of that. So let's talk about why. Let's dive in. All right, chances are you don't spend a lot of time thinking about interest rates, but that's okay. You got other stuff going on, like maybe family stuff or why the NFL won't change its overtime rules for the benefit of the fans. I don't know. Who knows? Anyway, so we're going to talk about three things. We're going to talk about the Federal Reserve, we're going to talk about spreads, and we're going to talk about time value of money. I'm not going to get too wonky here, but just some basics. What's been in the news lately? Why are they so important to the market? What's going on out there? Let's dive in and take a look at it. Okay, well, you can't talk about rates without talking about the Federal Reserve. It is that important. And if I could start this part out with making an analogy, a comparison, if you will. If the economy is like a car engine, the oil within that engine that keeps everything lubricated, that keeps things moving through the system, that keeps the engine running, is interest rates. It's not an exaggeration at all to say that that's the case. Interest rates are critical. You can't do anything without the ability to price risk. You can't do anything without the ability to price cost on lending between institutions and individuals. It is really that critical and that important. So that's what the Federal Reserve does at its basic function, is it sets the rate of lending from one bank to another. Now, contrary to many people's mistaken opinions or beliefs, they do not set the rates between you and your bank. Some people believe that, but that's not actually true. They do not have anything to do directly with your mortgage rate or your car loan rate or your credit card rate or anything else. They don't do any of that. They basically just set rates from between, let's say, JP Morgan and Wells Fargo to US Bank and US Bank to Bank of the West and whatever, okay? So all those banks lend to each other on a fairly regular basis. And when the oil of that lending stops, when the economy is in some type of crisis or when there's lack of confidence in the system, regardless of what country it's in, it could be in any country, the oil stops flowing through that system. So it's not an exaggeration to say that interest rates, the ability to price risk and the ability to price things, has to continue to move through the engine to keep that engine moving. So that's basically what the Federal Reserve does. It keeps the engine moving, it keeps liquidity and keeps credit available from bank to bank, and then those banks make the decision how they want to lend that to the public or other institutions. And they do that by setting what's called the Federal Reserve overnight lending rate. It's a very low rate of money, low rate of cost that has been around forever, and it sets the bank-to-bank lending rate, and then they make decisions based on that. But it does affect other rates too indirectly. So that's what the Federal Reserve does at its basic functions. It sets that overnight lending rate from bank to bank. All right, let's talk about spreads for a second. And without getting too far into the weeds, let's talk about what a spread is and why it makes a difference to you. Hi, Leo, he's back. Leo's back, everybody. So a spread is the difference between something at a cost and a profit level. So if you're a bank, the spread that you make is the difference between the depositor cost that you pay your depositors. Okay, you have a CD with a bank, savings account, they're paying you rate of interest, right? Even if it's low. And then the difference between that and what your lending generates for you in your profit. So a spread for a bank right now is tightening because their cost of money is going up like everybody else's costs are going up. So how this affects you directly is you should probably expect to see, number one, more volatility in the shares of stock that you own in your 401k plan, IRAs, Roth IRAs, etc. And the other thing you should probably expect to see is a higher increased loan cost across the entire economy. For example, this does make a big difference. If you have a $400,000 loan, let's say you buy a $500,000 home, you take out a $400,000 mortgage on a 30-year note, at a 4% rate of interest, that interest is $287,000 of total interest if you see the note out in its entirety. You change that to 5%, that's $373,000 roughly of interest on that loan. So it does make a big difference. Now, you don't necessarily have to pay all that interest, but you should expect to see across the economy for the next few years, the cost of things are probably going to go up, and you should probably try and build that into your expectations, and also just expect that that's going to affect the shares of stock you own as the company's costs go up. That's just kind of how it is, unfortunately, but those rates are moving higher, and that's what you should expect to see over the next few years. You should expect to see costs go up, and you should expect to see a bit more volatility than we've seen in the stock market than we've seen probably in the past 5 years. It's going to get more volatile. That will prevent some people from entering the market, but it will also present other opportunities for people who can take advantage of those opportunities. So what I would say to you is expect that your shares of assets that you own are going to be more volatile, and your costs are going to go up, but there will be other opportunities in the future given those dynamics. All right, let's talk about time value of money for a moment. So time value of money is a basic economic principle that says the following. The most valuable asset that you own is the asset you are about to invest today, right now. Now, I do care about my assets in 5 years or 10 years or 20 years or 30 years, but I don't have them to work with right now. I don't have that money to invest right now, so it's less important to me, and it should be less important to you. The most valuable asset you have is the asset you're about to put to work right now. That's time value of money principles and compounding. So we know the bad news. The bad news is that things are probably going up in price. It's going to cost you more to borrow money. It's going to cost you more at the store. So you probably should just build that into your expectations at some level. The good news is that most economic sectors, most shares of stock, most asset classes do fine over the long term when interest rates start to go up. Now in the short run, anything goes. Okay, you should just expect volatility, expect things to be choppy. But in the long run, these things do tend to work themselves out. Economies typically only experience rising rates because they're growing or recovering, which is a good thing. And the money you put to work right now in a well-diversified portfolio, and that can mean different things to different people. If you have questions about that, feel free to reach out. But a well-diversified portfolio should be a good place to be over the next 5-10 years as these things start to sort themselves out. In the interim, I guess I'll leave it at that. I hope you are all well. I hope you're taking care of yourselves. In these times of uncertainty, take care of your health, take care of yourself, take care of your family. I will see you again soon. If you have questions on anything that I've put forth here, or maybe you want to comment, please reach out. You can reach me at mcoyle@acgbiz.com, or I'll even give you my phone number, 651-262-8394 if you're the old school type. Take care of yourself, and I'll see you again soon. Thanks.